unex unexplored area of the topic. So we thought we will get to know the things, what is the provision on that. In fact, I remember very long time back, one of the Chinese philosopher, I think if I remember his name, he was Lao Tung. He said even a march of the civilization starts with a single step. That is what he said. I would actually say when we are actually marching towards, developing country to the developed country to the superpower, etc., and other thing and all, I would definitely think the regulation of the idea is nothing but it is in the global arena for us to explore the unexplored market of the Indian for the capital market for the foreign people so that, they can explore the thing. That is what I would actually think. In fact, coming from the foreign companies' perspective, it is actually foreign company. They actually see the India as a very good market, still remain as an unexplored territory, and they can actually definitely get attracted to the Indian market very easily. They can access the large Indian capital. That is one thing. They can get the pool of the money and they can raise, etc. It will work for them as a thing. Not only that, branding will happen to them in the global area. That is the thing. Apart from there in the local area, etc., the branding will happen. India being a very larger country, that is one thing. It is possible. But coming to the Indian perspective, we always, fascinated towards the foreign goods. We actually talk about it. Similarly, a lot of people, they want to invest in the foreign companies. But the thing is, investing in the foreign companies, it has got its own restriction, etc., and all this thing. And you can only restrict up to, something at $200,000 or something like that. Again, it is a very costly and cumbersome process. Because you have to open the account, bank account there, you have to get the demat account open there, you have to do the KYC, etc., and other thing and all those things are all there. So considering to that idea, if it happens here, then what happens? It is like a equity share trading, what we are investing. They will be able to invest. That is one thing we can have it. But only thing is what has happened since this has remained as an unexplored thing. The only known example to the best of my knowledge, I don't think, other than the Standard Chartered Bank, who would actually raise the IDR way back in 2010 or something like that. That's what they have done actually. That's the only known company today which has risen the IDR. In fact, if I remember correct, if I gone through, I think that is a 10:1. That means, Indian Depository Receipts, they represented one equity share of the bank. That's what they have actually done. But somehow that survived for a period of about 10 years, around 2020 or something, that they got terminated the IDR, they got delisted from NSE, BSE. That is the only thing. But more or less, this IDR is having a similar provision like a ADR and the GDR. And it is better to understand the technicalities, etc. and all this thing today and tomorrow. It might happen. It will be a new area for our practice and also people who are working in the employee. So it is always better to get to know the things so that we are geared up if it happens in the future. With these few words, I will ask Sudhakar to share because Sudhakar has been associated in the Reliance and he has handled the various GDR related issue, etc. He will be able to throw more light on that. Of course, 9 will take us through the various procedural issues and as well as the related provisions on this issue, and we will try to go along with that. Over to Sudhakar, please.
Yeah, thank you very much, and good morning, everyone. As Bala has rightly said, that this particular topic, uh, rather this instrument is not very popular as of now in India. In fact, it is not like that. When we were conceiving this particular webinar, that point of time, we too were in two minds whether to have it or not to have it. But if you see, as a part of listing regulations, one of the issue of securities is that by way of IDRs also. So something is not popular or something is complicated or something we don't know, that doesn't mean we should not be aware of that particular concept, rather the provisions. So keeping that in idea only, that we thought that let us spend at least 2 hours, if not more, to understand the concept of the DRs. What is a depository receipt? What is a GDR? What is an ADR? And what is an IDR? Suppose tomorrow, if somebody asks you this question as a company secretary, why, what is this GDR and what is this ADR? Or what is the IDR? If we cut a sorry face because we are not able to explain, then what will happen is that it will be, that it will not be good on our part, rather on our profession also. As I was telling before starting this webinar, to my knowledge, I don't know whether anyone has organized a program on these IDRs. Not even on GDR or ADR also, to my knowledge, it didn't happen. So whatever the little bit of knowledge I have on this particular subject is that when I was working with Reliance Industries, that we used to have GDRs. In fact, I have it. Rather, we had a training program from the our depository, which was there based in New York. That is the Bank of New York, in fact, and that's how I could got some knowledge. And we used to handle the GDRs when I was there. So before Nayan starts her presentation on IDRs, I'll give a bit of an idea about GDR to all of you, which I have handled it. I know some intricacies of that. That will help you to understand the IDRs without much of a ado. The advantages, first and foremost thing is what is the issue of GDR? GDR of course, the abbreviation of GDR is nothing but Global Depository Receipt. So the depository receipt is issued by a bank which is abroad for the underlying shares of foreign companies. That means, say, for example, Bank of New York is there. So Bank of New York, what it does is that this is like nothing but a derivative instrument. GDR or ADRs are derivative instruments because that instrument is having underlying shares are there. So the value of the DR is depending upon the underlying assets, that is shares. So whenever any Indian company wants to issue the shares or you want to tap the overseas market, you have two ways. One is debt and another one is equity. Sometimes debt might be very costly and equity might be cheaper. So if you want to tap the equity market abroad, you cannot do that because Indian companies can't list their shares in the overseas stock exchanges. So the mechanism available to you is by issuing the DRs. So here what happens is whenever Indian company wants to issue shares the global market, that is only by way of DRs. So you have to have a banker who will be able to take the entire issue and he will issue whatever the issue size is there. And then accordingly, you have to work out the DR. Sometimes the underlying shares may be 10, sometimes underlying shares may be 5, 2, 1, whatever it may be. In case of Reliance, we used to have for every GDR, the underlying shares are 2. Accordingly, the GDR price will be fixed. So it is the banker who is taking the shares. He will issue the DRs in turn to the local people there. There will be a custodian here in India. The shares will not be exported. The shares will be allotted. The shares are held by the custodian. Suppose if Reliance is giving GDRs to the Boni Bank of New York, what will happen is that they have a custodian here in India, and the custodian will be holding the underlying shares of that particular GDR. And the Bank of New York, the depository or the bank which is issuing the DRs, they will maintain a register. As far as Indian company is concerned, it is the bank or the depository which is issuing the DR. It will be in the ROM of your company as a shareholder. And the people who have subscribed the DRs, we may not be even be knowing that who are those people. We have nothing to do with them. The depository to whom you have issued the DRs, who issued the shares, that depository for all purposes is your shareholder. They have even voting rights and they can also appoint a proxy because they are the registered shareholder as far as your register of members is concerned. And why we issue this thing? There is number one, of course, to tap the foreign market. Second thing is when you are able to issue the GDRs or ADRs, ADR is nothing but American Depository Receipt. The concept is the same. Global Depository Receipt, anywhere in the global you can issue that. But except in America, because their rules are entirely different. So you cannot issue GDRs in America and they cannot even subscribe that. Whereas in America, if you want to do that, you have to issue ADRs. And ADRs are listed in the New York Stock Exchange and Nasdaq, either of the one or both. Whereas in case of GDRs, mostly they are issued in the Luxembourg Stock Exchange and London Stock Exchange, or sometimes even Hong Kong also. The issue, the procedural compliances in case of Luxembourg Stock Exchange are very, very minimal. A notch above is London Stock Exchange. But ADRs are very tough because you have to completely apply, comply with the NASDAQ or NYSE provisions, which are slightly harsh. If I am not wrong, in fact, Infosys has listed its ADRs on the, that NASDAQ. So one advantage is you're tapping the foreign market. Second thing is the credibility of the company will immensely grow. When you are able to issue the DRs in the foreign market and it is subscribed, obviously the credibility will be more. And the investors also can diversify their holdings. And the liquidity of share will be more. And the DR holders, are they entitled for if you are issuing a declaration, declaring a dividend, whether the dividend will go to the depository, DR holders? Answer is yes. Say, for example, if Reliance is declaring dividend, what will happen is the proportionate amount, whatever the number of shares are held by the depository, they will get the dividend and in turn they will distribute that dividend to their DR holders. So similarly, in case of any rights issue is there, the DR, the depository may subscribe or may not subscribe. If they are not subscribing it, obviously that first of all, we will have an understanding with them. They subscribe it, by all means, they can do that. And in turn, obviously, they have to ensure that their DR holders will also have to pay the money to have that many number of GDRs with them. And in case of bonus issue, are they entitled for the bonus? Obviously, answer is yes. Again, the same thing, because the depository, the Bank of New York, which is going to be a shareholder of yours, they will get the bonus shares. And in turn, they will distribute those shares to the respective DR holders. And these depository receipts, they are fungible. Fungible means that both ways, you can get it cancelled and you can get it issued. Say, for example, if I am a GDR holder staying in London, having Reliance GDRs, and I want to cancel my GDRs and I want to have the shares. Can I have it? Answer is yes. It depends upon their local laws also, they have to see that. But as far as the mechanism is concerned, you can always cancel your GDRs and you can own the shares. It may be may have to open a demat account here in India. You have to have a broker here. That broker will suppose get you the shares, and sometimes it may so happen the broker may be holding the shares on your behalf. This is all subject to the rules of the respective countries. You have to have the mechanism, what I am telling you. Now, when the DR holder is cancelling his GDR and getting the shares, who will transfer the shares? It is the local custodian, because the custodian is having the shares. So when a GDR holder is cancelling his GDRs abroad, the depository there, which has issued those GDRs, it will advise its custodian to release the underlying shares because he has cancelled the GDRs. Now, what will happen is, say, for example, if Reliance has issued 50,000 GDRs abroad and the underlying shares are 2 per GDR, the total shares are 100,000, that is 1 lakh. The custodian is holding 1 lakh shares. Now, the GDR holder is cancelling 100 GDRs. That means he will have to get 200 shares. So 50,000 GDRs minus 100 GDRs, as per the GDRs, we are having 49,900, means 99,800 shares in the ROM the depository is holding. So there is a headroom available for 100 GDRs because the GDRs got cancelled. If somebody wants to buy the GDRs, they can buy that thing. Even an Indian shareholder, if he wants to buy the GDRs, he can approach that Bank of New York and he can, or any other depositor. I'm just giving it the Bank of New York only the name. anybody there who is the person who has issued those DRs, he has to approach them and he has to say that, look, the headroom, if it is available, I would like to buy the JDRs. Then that, of course, for you have to remit the money in the foreign currency, the RBI rules have to permit you, and all those rigmaroles are there. But technically, you can buy that GDRs. And then what will happen is that 100 GDRs will be issued to you. And what you have to do is when you are buying it, you cannot remit the cash. You have to surrender your shares. You can convert your shares, existing shares, into the GDRs. So again, the custodian here, he will be getting the 200 shares against which that 100 GDRs have been issued. So this is called as fungibility. That means you can create the GDRs and you can cancel the GDRs also. Fresh GDR, that means you cannot issue fresh GDRs by taking the money from somebody, because ultimately, whatever the issue size is there, that cannot be changed. Whenever there is a cancellation takes place, somebody else can buy that particular thing. Okay. And this is called as, this suppose what's called headroom. This is primarily more or less on this pattern. IDRs also are there. That means what? If a foreign company, so far what we are discussing is an Indian company tapping the foreign markets. Suppose if a foreign company wants to tap the Indian market, as Bala has said that, Nayan also will explain it, the Stanchart Bank has issued GDRs. I think that is the only company maybe so far which have issued it. That's what I have been told. If Stanchart wants to tap the Indian capital market, what they have to do is they cannot issue their shares in the Indian market. So what they did was they have issued the Indian Depository Receipts. So there should be a depository here which has to take that underlying shares. There must be a custodian also. And then the IDRs will be issued to the local people there. So what will happen is IDRs will be issued to the Indian shareholders here. Is the advantage of buying the shares which are abroad. That means bank shares, maybe, I think if I am not wrong, as on date, we can buy foreign company shares also. I think there is a stock exchange in Gift City and all those are all different things that we will discuss it, that mechanism separately. But earlier this was not there. So if I have to buy the shares in the overseas market, I cannot do it directly. The only way available to me indirectly is to buy this kind of a derivative instrument that is nothing but IDR. So I give a pause here. Let Nayan start her presentation. And over her presentation, we will discuss it further. Thank you. And let me also put a kind of a disclaimer that don't take this, whatever we are saying, this is the ultimatum. This is only giving you some kind of an idea. Frankly speaking, we never, at least myself, Bala, or Nayan, we never handled any IDR issue as such. But what we are discussing is primarily whatever the legal provisions are there, to the best of our ability and understanding of the subject we are trying to explain, so that you will have a fair amount of an idea. And whenever you have to handle this particular instrument, then you have to go deep into it. You have to take a deep dive into the subject and then understand it in the intricacies of the same. Thank you.
Thank you, Sudhakar. You put it well. And when you explain the fungibility, to add a little more thing is there, suppose a person from India, he goes abroad. As you rightly say, he wants to invest in the Reliance share. So he can actually buy the GDR, ADR, depending upon wherever he is situated there. If it is America, ADR, otherwise it is GDR. Then suppose after 10 years, he comes back to India. When he comes back to India, then as you rightly say, because the fungibility is available, he can surrender the GDR, ADR, and he can get the share converted. Similar is the case whenever people who are holding the share here, when they go abroad, they can actually get converted. That is one big advantage is there people who are actually, settled there, who are coming back or who are going here and settling there. I think that helped for the fungibility issue, what you just cited. I think I'll ask Nayan to take us through the various provisions related to the IDR. Over to Nayan, please.
Yeah, thank you, Bala sir. Thank you, Sudhakar sir. So good morning, everyone. And thank you for joining this today's webinar on public and right issues of the IDRs. So it is a pleasure to be here with such an engaging audience to keep an understanding, who are keen to learn about the important aspects of the financial markets. So in today's discussion, we're gonna explore the frameworks which is governing the IDRs, their roles in capital market, and the regulatory landscape that enables the foreign company to raise capital in India. So cross-border investment opportunities continue to expand, and IDRs provide a significant avenues for the Indian investor to participate in those equity of the foreign companies without directly investing in the overseas market. So let's begin with the presentation with the fundamentals first of all. So what exactly are the Indian Depository Receipts or IDRs? So IDRs are the financial instrument that allow foreign company to mobilize funds from Indian capital market without directly listing their shares on the Indian stock exchange. So they are rupee dominated depository receipts, which is issued by the domestic depositories in India. So which represents an ownership interest in the equity shares of the foreign company. So essentially, they work similar to the equity shares, giving investors a stake in the issuing company. So to put it simply, IDRs are created by the Indian depository against the underlying equity share of a foreign company. So this enables Indian investors to gain the exposure to the shares of the international companies, which would otherwise be listed on the foreign stock exchange. So like equity shares, IDRs are unsecured instruments which are freely tradable among the investors in the secondary market. And if we look at the regulatory perspective, the company's issue of IDR rules 2004, it were introduced under section 605A of the Companies Act 1956, laying down the framework of the IDR issuance. So the first ever IDRs in India debut on BSE and NSE, it was on June 11, 2006. Since then, SEBI has regulated IDRs and ensuring that they are issued in a manner which is similar to the domestic shares. So understanding the flow of IDRs, now let's look at how they actually work. And this diagram simplifies the IDR issuance process. So first of all, it all started with the foreign company that wants to raise funds in India. And this company issues its share in local currency, for example, in US dollars. These are then deposited with the domestic custodian in India, and the custodian hold these share on behalf of the foreign company. So this custodian work with the IDR, Indian Depository Bank, to convert these foreign shares into the IDRs, and then this depository bank issues the IDR which are dominated in Indian rupees. Indian investors can now purchase these IDRs just like they would buy shares of the Indian company, and in return, they will receive an acknowledgement which confirms their ownership of IDRs. So these IDRs can be traded in Indian stock exchange, allowing investors to indirectly invest in the foreign companies while dealing in the Indian rupees. So in short, it provides a way of foreign company to raise money in India while giving Indian investors access to the global stock exchange without dealing with the foreign exchanges. So why were Indian depositories IDRs introduced in India? So now let's discuss it. So one of the key reasons is that foreign companies are not allowed to list directly on the Indian stock exchanges. So this created a challenge
Just 1 minute, 9, just go back to the previous slide.
Yes, sir.
If I am not wrong, the foreign company issue the shares not to the domestic custodian, means you mean to say the custodian who was there abroad. Am I correct? Not in India.
Yes, not in
No,
India.
not in India. Domestic
Yeah.
means their,
So
their domestic.
see, why
Local
I'm
custodian.
clarifying this is that participants should not misunderstand that domestic custodian means here and the custodian here in India. It is not so. The custodian who is there abroad only. The shares will be issued to the custodian who will be there, maybe on the issuing country itself. Yeah.
Yes, sir.
I thought I would clarify that.
Thank you, sir. So one of the key reasons is to, the foreign companies are not to allow the list directly on the Indian stock exchanges. And these created a challenge for Indian investors who wanted to invest in the global companies. To bridge this gap, the IDRs were introduced. And if we look at the bigger picture, India has allowed its companies to raise funds from the international investors since April 1992 through the instruments like ADR, GDR, and these allows Indian companies to access the global capital market. So similarly, to provide the Indian investors an opportunity to invest in foreign companies without the complexities of foreign exchange regulations, IDRs were created. So just like ADRs and GDRs, IDRs are derivative instrument which is backed by the equity of a foreign company. So they provide Indian investors with the ownership interest also in the global firms. Like IDR holders enjoy the same right as regular equity shareholders, like voting right, bonus and right issues, dividend, other shareholding privilege. In essence, we can say the IDRs were introduced to globalize the investment opportunity for the Indian investors. So who are the intermediaries involved in the IDRs? So as before understanding it, there are several more entities who play a very crucial role in smooth issuance and functioning of the IDRs. Like foreign company, their issuance company has to be there. Then domestic custodian bank, a financial institution in India that holds the underlying shares of the foreign company in its custody. Then Indian depository banks. Then the SEBI plays a major role in regulating these authority, overseeing the issuance process. Then comes the stock exchange, BSE and NSE, and merchant bankers. And then the last is Indian
Nayan, your
investors.
Wi-Fi is unstable. It is not in between. The breaks are coming. Please take care of it. Your Wi-Fi is
Okay.
not a bit stable. Okay, so take care of that. Yeah,
Yeah,
go
sure.
ahead.
So these are the parties which are involved in the IDRs. And now we covers the regulatory framework for the IDRs. So let's discuss.
Somebody has put up a question. What will be the foreign custodian issue to Indian depository? As Sudhakar puts it very clearly,
Just go
foreign
back to the
custodian.
previous slide. Nayan, go back to the previous slide. Then Bala is explaining.
Okay. If you look at the diagram also, it is very clearly said the custodian actually keeps the underlying equity share with them as a custodian. They don't issue any depository receipts actually. Because based on the custodian who's keeping the shares corresponding to that, it is actually Indian bankers who are acting here, actually issuing the depository receipts here. That is the thing. Because the custodian doesn't issue the depository receipts at all. Custodian only holds the underlying share with them. Instead, in Indian companies, Indian country, the banks who are actually issue the depository receipts. That is the point here.
Nayan, come to the next slide, please.
Please clarify that when ADR and GDR receipt issued in Indian investors is similar to equity share allotment by Indian companies. Yeah, it is more or less the same, because the thing is, instead of the Indian companies keeping equity shares in the local custodian here, the foreign companies keep their own local custodian, the equity shares there, and correspondingly, like a JDR, EDR issued, IDR is issued here.
See, just to explain further, that whenever, see, in this case, in this particular slide, there are 4 intermediaries are there. That is the issuing company. That means any company which is an overseas company which is intending to issue the IDRs here in India. So what it has to do is that whatever the procedure 9 is going to mention, it has to comply with the procedural part, and it has to have necessary approvals and all. And it has to choose one depository, and that depository will be issuing the DRs. And this depository is to be registered obviously with SEBI. So we have 2 depositories. They have to choose either of them. After that, this depository will be having its custodian abroad. Okay, so it is not the issuer company which is going to decide the custodian. It is the depository which is going to decide the custodian. And the depository will ask the issuer company to issue the shares to that particular custodian, the underlying shares. The custodian is the shares are in the custody of that custodian. And then, of course, the merchant banker is there. He is the person actually who has to ensure that entire process of this issue of IDRs is there as per the procedures of the Indian regulations and laws. And ultimately, the foreign company also ensures the necessary compliances while making that IDR issue. Yes, ma'am.
we are going to discuss the regulatory framework for the IDRs. Since IDRs involve the foreign companies for raising capital from Indian investors, so their issuance and trading are governed by the multiple laws and regulatory bodies. The key framework includes the Companies Act 2013, the Companies Registration of Foreign Companies Rule 2014, the SEBI Issue and Capital of Disclosure Requirement Regulations, and then SEBI Listing Obligation and Disclosure Requirements, and then the RBI regulations. So together, these regulations ensure that IDRs are issued transparently, traded securely, and comply with the both Indian and international financial laws. So SEBI ICDR Regulation 2018 talks about the public and the right issues of the IDRs. So we're going to focus it which governs the public and right issues. So now they are divided into two key chapters, that is chapter 7, which covers the IPO, that is initial public offering of the Indian Depository Receipts, and chapter 8 covers the right issue of Indian Depository Receipts. So we're going to discuss about the chapter 7. So this is for the first time issuance of the IDRs by the foreign companies in India, and it gives the eligibility criteria, disclosures, pricing, listing requirement, and the investor protection measures for the IDR IPO. And chapter 8 covers the right issues, where existing IDR holders get the right to purchase additional IDRs at a predetermined prices, which ensures that the right issue process follows the fair pricing, proper disclosure, and investor-friendly practices. So chapter 7, which is the initial public offer of Indian Depository Receipts. So this chapters outline the rules and requirements of the foreign companies who issues the IDR in India. So the key provisions follows the applicability, eligibility requirement, disclosures, pricing, and issuance conditions and the procedures. Now we talk about the applicability of the IDR regulation. So Regulation 181 of the SEBI ICDR regulation says that chapter 7 shall apply to the issuance of IDR in accordance with the Companies Act and Companies Registration of Foreign Companies Rule 2014. Section 2, subsection 48 of the Companies Act 2013 defines the IDR as in any instrument in the form of depository receipt created by the domestic depository in India and authorized by a foreign company issuing such receipts. Section 390 of the Companies Act 13 empowers the CG
Just 1 minute. Go back to the previous slide. So just to explain it further, that as it is defined in the subsection 48, it is very clearly said that Indian depository receipt means an instrument in the form of a depository receipt created by a domestic depository in India and authorized by a company incorporated outside India. That means the company which is incorporated outside India, it wants to tap the Indian capital market. Since it cannot do it directly by issuing its shares in the Indian stock market and get it listed. So what it is doing is it will be approaching a depository, first a merchant banker who has to ultimately approach the depository. That he is going to get the depository IDR holders ultimately who are going to subscribe to that issue. That's how it will, get the depository will be getting the money, which it will give it to the foreign company so that it will allot the shares to the custodian, which is appointed by the depository. This is how the mechanism works. Yeah.
So Section 390 of the Companies Act empowers the central government to frame such rules regarding the offer of the issue, depository custodian, disclosure requirement, sale, transfer, and transmission of the IDRs. And Rule 13 of the Companies Act state that foreign companies issue IDR must comply with the conditions under this rule and SEBI Regulation 2009, then RBI. So if we talk about eligibility requirement for the issuing the IDRs, so under Rule 13 of the Companies Act, there are some eligibility requirement have given, like for a foreign company to issue the IDRs in India, it must have a strong financial background and pre-issue paid up capital and the free reserve of at least $50 million. And there should be the minimum average market capitalization of $100 million in its home country over the last 3 years. And it should have a track record of distributable profits for at least 3 years out of the last 5 years. And the company must be trading on the stock exchange in its parent or a home country for at least last 3 years. And it must fulfill any additional eligibility criteria which is prescribed by the SEBI from time to time.
So primarily, if we see that, if we see that the regulator is ensuring that anybody and everybody from foreign companies, they cannot come and issue the IDRs here and make the Indian public fool of that thing. So what they are doing is, if anybody wants to issue IDRs in India, that company's credentials are also to be established, and that credentials are based on the financial strength of that thing. Apart from other, whatever the other compliances are there, that of course Nayan will explain. But in this particular slide, if you see that they have to have a market cap of $100 million, and they have to have a paid up capital and free reserves of $50 million. So that itself gives, plus of course the 3-year track record and other things are there. So this resembles the financial strength and financial soundness of the company, so that the Indian public can put their money in that ideas. Yeah.
Yeah, the whole idea goes actually the safeguarding of the investors' interest. They don't lose the money unnecessarily by somebody. That is the whole idea here. Yeah.
Yeah. So, and there are other eligibility criteria which is given under 183(1) of the SEBI ICDR regulations. So, in addition to the company rules, there are other additional requirements given in the ICDR. So, the issuing company must be listed in its home country for at least 3 years. The company must not be restricted from issuing the securities by any regulatory body, and the company must have a track record of compliance with the security market regulation in its home country. And none of its promoter or director should be fugitive economic offender. I think these eligibility conditions, it ensures that not only the financial stability, but the company has to be well regulated, compliant in the foreign companies who can raise funds in India through IDRs. So there are other eligibility conditions as per IDR regulations. So like first condition is described in regulation 183 sub-regulation 2, which talks about the minimum issue size shall not be less than 50 crores. At any time, there shall be only one denomination of IDRs for the issue, and the foreign company must ensure that its underlying equity shares are already listed and will be listed in its home country before the IDRs are listed in India. And the underlying shares of the IDR must rank pari passu, means equally with the existing shares of the same class in the issuing company. And conditions under regulation 183 sub-regulation 3 must further, in this, issuer must ensure that the issuer has applied to one or more stock exchanges in India for an in-principle approval and selected one of its designated stock exchange. The issuer has entered into an agreement with the depository or the dematerialization of IDRs, and the issuer has arranged 75% of the required funds for the proposed project through variable means, excluding amongst the raised through IDRs and internal accrual. So the amount allocated for the general corporate purpose shall not exceed 25% of the total amount, which is being raised through the IDRs.
Somebody is asking, is IDR is a equity share? I think probably you have not heard Sudhakar very clearly. Sudhakar says it very, very clearly. It is the equity shares of the issuing company who are actually kept with the custodian in their country. Based on that equity shares which are kept in the custodian, the depository receipts, which is actually a derivative instrument, which is actually issued. But for all the practical purposes, it is as good as like that of the equity share. You are the shareholder of that company, entitled for all the rights, right from voting, right from participating, right from getting the dividend, right from getting bonus, any other benefit which are associated with the equity share itself. But only thing is the form is not in the equity share, form is in the DR receipt. That's all. Because it is a derivative instrument, you are holding it because it is being in the other country, it is a share which they cannot issue directly here. That is the whole purpose. Yeah.
Yeah. Thank you, sir. And then we come, before understanding all these eligibility criteria. Now we are moving towards the disclosures in the offer document. So which is, described in Regulation 185 of the ICDR. So the offer document must contain all the material disclosures, which should be true, correct, and adequate to help the investors to make informed decisions. And the offer document shall include the disclosures which is specified in the company's registration of foreign company rules and disclosure as per Part A and Schedule 8 of the SEBI ICDR Regulation 2018. And due diligence by the lead manager. The lead manager must verify all the details in the draft offer document and ensure that the accuracy and adequacy of the disclosures. And like the lead manager must also ensure that the issuer, promoter, and director fulfill their obligation as disclosed in the offer document. So now here we're going to discuss about the regulation 186 of the draft offer document and offer document. So the first of all, submission of the draft offer document is described in Regulation 186 Sub-Regulation 1. It says before launching the IPO of the IDR, the issuer must file 3 copies of the draft offer document with the SEBI, and this must be done as per Schedule 4 and along with the prescribed fees which is given in the Schedule 3. And the filing must be done through the lead managers. Sub-Regulation 2 of 186 says apart from the physical copies, the draft offer document and the final offer document must also be submitted to the SEBI in the soft copy. And the responsibilities of lead manager is to confirm that an agreement has been entered between the issuer and the lead manager. And they submit a DD certificate as Part H of Schedule 5 along with the draft offer document and certify that SEBI's observation, amendments, and suggestion have been incorporated in the offer document or not. And submit another due diligence certificate as a Part C of Schedule 5 when filing the offer document with the Registrar of Companies. If any material development occurs after the draft submission, a Form D due diligence certificate must be submitted with the public notice disclosure.
And somebody is asking who appoints the lead manager.
So as per my understanding of this regulation, I think the Indian Depository has to appoint the lead manager.
No, not like. See, it is the issuer who has to appoint the lead manager.
Yeah, it is the issuer,
But
issuing
Why
company.
depository will do it? If you are coming with an IPO, if you are coming with an IPO, okay, if you are coming with an IPO, who will appoint the lead manager? It is the company which is coming with the IPO. And similarly, that company approaches a depository to have its shares allotted to the depository holders. The mechanism is the same here also. What it will happen is the company which is issuing the IDRs in India, it has to appoint the lead manager. Ultimately, it is the lead manager who has to advise that issuer company by which is the depository good, which is the depository they have to approach. And then ultimately the lead manager is the linchpin for the whole thing. Okay. And the lead manager, in fact, ensures the procedural requirements as well as whatever the credentials of the other company is required as per the Indian laws. That is also the lead manager has to ensure that before they file the offer documents or whatever it is with the SEBI.
Yeah, you're absolutely right. Actually, Sudhakar, you very much clarified. It is like exactly the issuer company, it is his responsibility upon the lead manager. Maybe he might run the credentials, etc., with the help of the Indian people, who are the people, etc., and among them, they can select. That is the thing. Another question somebody is asking, since the depository receipt issued to the investor, ADR in the case of the US is the equivalent to ENR, how the exchange fluctuation rates are taken care of?
See, there is no exchange fluctuation when you are issuing the IDRs. Okay, if we are talking about, say, for example, if I am issuing the GDR, Indian companies are issuing GDR or ADRs, which are listed in the Luxembourg or London Stock Exchange in case of GDRs and NASDAQ or New York Stock Exchange in case of ADRs. So there is no question of any foreign currency and all. Whatever the prevailing market value is there on that particular day, accordingly, your ADR and GDR's value will be there. Same is the case with here in India also. IDRs are there, which are listed on the stock exchanges. And what is the IDR price? IDR price depending upon the derivative shares, which are the underlying shares. So that underlying shares, whatever the mechanism is there, suppose abroad, if say for example Standard Bank, the shares of that thing is say $200 per share, and you are issuing one IDR for every two shares. So here what will happen is that person, whoever it is there, the underlying that ADR, IDR might be issuing at about $400, equivalent to Indian currency. That is how the mechanism goes.
Yes, Ryan, go ahead.
So, Regulation 186, Sub-Regulation 4 is talking about the submitting the final offer document with the ROC. And the issuer must submit an updated draft offer document to the SEBI, which is highlighting all the changes have been made. Regulation 185, Sub-Regulation 5, it talk about if there are any significant changes in the draft offer document concerning the matter which is mentioned in Schedule 16, the issuer must file an updated or a fresh draft offer document, the SEBI, along with the applicable fees. And once the offer document is filed with the ROC, a copy must also be filed with the SEBI and the stock exchanges through the lead manager. Now, Regulation 187 talks about the public availability of the draft offer document. And transparency is very crucial in this capital market. And this regulation allows investors and the public to review and comment on the draft offer document before the final issuance. Sub-Regulation 1 talk about the public availability or the comments. And once the draft offer document is filed with the SEBI, it must be made public for at least 21 days for the comments. And the document will be hosted on the websites of the issuer, the foreign company who is issuing the IDRs, SEBI, stock exchanges where the IDRs will be listed, and the lead managers who are associated with the issuance. Sub-Regulation 2 talk about the public announcement. And within 2 working days of filing the draft of a document, the issuer must make a public announcement in one English national daily newspaper, which is to be widely circulated, and one Hindi national daily newspaper. And that announcement informs the public about the filing and the invites the comments from the investors.
Somebody has put up a question, can a compulsory convertible debenture be issued through the depository receipts?
No, it cannot be. The underlying instrument should be shares only, not the
we are talking about the security here, actually underlying shares only. So debenture will be out of the purview of this. It will be only the shares. Yeah. Yes, Ryan, go ahead.
Yeah, Sub-Regulation 3 says the review and the filing of the public offer document. So after the 21 days, the public comment period is over, the lead manager must collect all the feedback from the investors and the stakeholders and submit a report to the SEBI, which is detailing all the comments which it has received and what are the necessary modifications in the draft offer document has to be done. And after that, the hosting and consistency of offer document, the final document must be hosted online by the issuer, SEBI, stock exchanges, and the lead managers. It must be identical to the one filed with the SEBI and the ROC. And Sub-Regulation 5 says that lead managers and stock exchanges must provide copies of the offer document to the public upon request, and a reasonable fee may be charged for providing those physical copies. Regulation 188 talks about the pricing of the IDRs. And the issuer must have flexibility to set up the price of IDRs in 2 ways. In consultation with the lead manager, where the pricing is determined based on the market condition and investor demand, and through the book building process, where the market-driven mechanism where investors place bids and the final price is decided based on the demands. And if the book building process is followed, it must be conducted as per the guideline which is specified in Schedule 13 of the SEBI ICDR regulation and ensure the fair price discovery and prevents the price manipulation. Regulation 189 talks about the price and the price bands. Now, Sub-Regulation 1 says the issuer may mention a price or a price band in the offer document. In a fixed price issue, the issuer may directly mention a single price or a price band in the offer document. And in a book building issue, the issuer can mention the floor price or a price band in the RHP, red herring prospectus, and finalizing the price before registering the prospectus with the ROC. Subregulation 2 says the price band limitation. The upper cap of the price band cannot exceed 120% of the floor price, and it ensures that the price range remains with the reasonable fluctuation limit for the investors. And the floor price or final price cannot be lower than the face value of the IDRs. Under Subregulation 4, the issuer must announces the floor price or a band price at least 2 working days before the issue is open, and the announcement must be made in the same newspaper where the public announcement under Regulation 187 Subregulation 2 was published.
Yeah, nowadays, more or less, the fixed price doesn't have any, significance today, because if you see in the recent past also, whatever the IPOs which are happening even in the Indian market as well, it is actually the price band normally mentioned, the price recovery mechanism is working.
Yeah.
And especially it will be so because when you are going for the first time, there is no established market which is actually readily give you the price available in the marketplace. Because the marketplace is there, that's a different thing. Because it is already established, you can actually come to the price because it's a well-established price, etc. is there. But since it's going for the first time, the fixed price may not have that sort of a thing. That is what we have been seeing it in the recent past also. So normally everything is coming only on the price band here. So Dagar, you may like to add something?
Yeah, I agree with that. In fact, you see that the pricing mechanism, whatever the guidelines are there, in addition to that whatever the band is to be given, that also there is you cannot just give it, at the way you feel like it. And similarly, in case, depending upon the market situation, if you have to revise that, it can be done. But again, subject to that conditions, whatever Nayan has mentioned it.
Yeah, go ahead, Nayan.
Yeah. So Subregulation 5 talks about the financial ratio disclosures, and the public announcement of the price band as per regulation for Subregulation 4 must include the relevant financial ratios which are calculated for both upper end of the price band and the lower end of the price band. So the announcement should also direct investors to the section titled the basis of issue price in the offer document, and this will help investors to access the valuation of the IDRs making before an investment decision. So, Subregulation 6 talks about the online disclosures for the transparency. The price band announcement and the financial ratio must be disclosed on the stock exchange website where IDRs are to be listed and pre-filled in the application form which is available on the stock exchange portals. So, this Regulation 190 talks about the differential pricing, and a provision that allows investors to offer IDRs at different prices for the different categories of investors. Like for Subregulation 1, issuers flexibility to the offer different prices. For the retail individual investors, they may offer IDRs at a price not lower by more than 10% of the net offer price, which is available to the other categories, excluding the anchor investors. And alternative book building method, if the issuer opts for this method, it may offer the IDRs to the employee at the price which is not lower by more than 10% of the floor price. Subregulation 2 says the discount must be clearly specified, and like if the issuer provides any discount, it must be clearly mentioned in rupee terms in the offer document. So here there are few regulations like 191 to 211 which covers the conditions and provisions for issuing the IDRs, and due to the time constraint we will focus only the few key regulations that are crucial to understand the process. Regulation 191 talks about the issuance condition. So the offer document must be clearly specify the procedure for each class of applicant, ensuring the transparency. And investor must apply for a minimum amount of 20,000, making the IDR accessible to the serious investors. 192 talks about the allocation in the issuance. The 50% of the issue is reserved for the QIBs, that is qualified institutional buyer, on a proportionate basis. The remaining portion is distributed in the non-institutional investors, retail investors, and employees as per their issuer's direction. And retail investor protection, at least 30% of the IDR must be allocated to the retail individual investors. And there is no individual can apply for more IDRs than the total available for the public. So regulation 193 is talking about the abridged prospectus. And what is abridged prospectus? Basically, it is a summarized version of the offer document that contains all the key disclosures which are specified in Part B of Schedule 8, which excludes the extraneous detail and the focus on the essential information only for the investors. So there are mandatory distributions. Every application form issued for IDR must be accompanied by the abridged prospectus, which ensures that investors receive the crucial information before making any kind of investment. Now, Regulation 194 talks about the SEBI and the Security Deposit Regulation that the issuer is required to accept the bids using only the SEBI facility. So SEBI is application supported by blocked amount, which is specified by SEBI. And this means that investors' fund remain in their bank account and are only debited once the allotment is confirmed. And SEBI, it enhances the transparency, reduces the refund delays, and prevent the misuse of funds. And under Regulation 197, before the public issue opens for subscription, the issuer must deposit 1% of the issue size with the designated stock exchange.
All these are more or less IPO conditions only. Even if you want to issue shares in the Indian stock market, more or less the same conditions are there for that also. Yeah.
So Regulation 198 covers the underwriting. So underwriting plays a very crucial role in assuring that the success of an IPO of IDRs. Underwriters for non-book building issuance, sub-regulation 1 says if an issuer opt not to use the book building process, it can choose to underwrite the issues by appointing the underwriter as per the SEBI underwriter regulation 1993. And this ensures that a certain amount of IDRs are subscribed even if the demand is low. Sub-regulation talks about the underwriting for book built issues. In case book building, the issue must be underwritten by the lead manager and the syndicate members. And before filing the prospectus, the issuer must sign an underwriting agreement with them. So there are some key regulation which is to be fulfilled by the underwriters. If there is an undersubscription, underwriter must purchase the remaining IDR at the pre-agreed price. If syndicate members fails to meet their underwriting commitments, the lead manager must step in. And if the lead manager and syndicate members cannot subscribe to the issue except to fulfill their underwriting obligation, so the minimum underwriting obligation must be met as per the SEBI Merchant Banker Regulation 1992, and the total underwriting obligation must at least cover the minimum subscription requirement. And this ensures that the IDR issued is backed by the financial support which reduces the risk of failure. Now, Regulation 200, which covers the issue-related advertisements. Sub-regulation 1 says the issuer may release the advertisement for issue opening and issue closing. And these ads must follow the formats which is given in Part B and C of Schedule 10. And they must be published in the same newspaper where the IPO of IDR was made under Regulation 187. Sub-regulation 2 says advertisement not allowed during the subscription period. No ads can suggest that the full issue is fully subscribed or oversubscribed, and there is a strong investment demand for the issuance. Sub-regulation 3 announcement of the issue closure can only be made at least 90% of the issue is subscribed, and a certificate from the registrar must confirm that before the announcement, and the closure announcement must follow the SEBI's prescribed format. So Regulation 201 covers the opening of the issue. So a public issue may be opened only if the complies with the Companies Act and the following conditions. There are option 1, within 12 months from the date of receiving the SEBI's observation under Regulation 6, or at least 3 working days after registering the prospectus with the ROC. Regulation 202 talks about the minimum subscription. So one of the key requirements under the public issue of IDR that issuer must receive at least 90% of the offer size through the offer document. And non-underwriting issues, sub-regulation 2 talks, if the minimum subscription is not met by the closure of the issue, the issuer must refund the entire subscription amount immediately through the variable means. Or if the refund is delayed beyond 15 days, the issuer must pay the interest at 15% per annum to the subscribers for the delay. And for underwritten issues, if the minimum subscription is not met, even after the underwriters step in, the entire application money must be refunded within 15 days of the closure. And if delayed, the issuer must pay the interest of 15% per annum to the subscribers. And the lead manager must report any underwriters who fail to fulfill their obligations to the SEBI. Regulation 2303 covers the period of subscription. And an IPO for the IDR must be kept open for the 3 working days and maximum for the 10 working days. And if the price band is revised in the bidding period, must be extended by at least 3 working days, ensuring that investors have adequate time to respond. And there is an exceptional circumstances in sub-regulation 3 where the force majeure events like natural disaster, political instability, if it comes like banking strikes or similar disruption, and they may extend the bidding for issue period by at least 3 working days, providing the following, it follows the original duration limits. So the allotment process covers under Regulation 204, which ensures the fair distribution of securities among the investors while maintaining the transparency and the regulatory compliance. The sub-regulation 1 says the issuer cannot allot the securities beyond the number which is stated in the offer document, except in case of oversubscription for rounding off. And in case of oversubscription, up to 1% of the net offer may allot it to the facilitate rounding off. Sub-regulation 2 says allotment for the different investor categories. Like in retail investors, securities worth up to 2 lakh can be allotted per investors. The minimum allotment must be equal to the minimum bid lot as stated in the offer document, and any remaining shares shall be distributed proportionately. And sub-regulation 3 ensures the fairness, and this designated stock exchange lead manager and the registrars will jointly ensure that the allotment process is finalized in fair and transparent manner. So Regulation 206 covers the post-issue advertisement. So why are post-issue advertisement important? Because to ensure the transparency and the investor awareness. So there should be the key details in the advertisement, which is mentioned in sub-regulation 1 of 206. It says about the subscription details, number, value, percentage of application, including SBA, basis of allotment, number of successful allottees, date of refund orders, or instructions of to self-certified syndicate banks if applicable, and date of crediting IDRs to the investor's account, date of filing the listing application with the stock exchanges. Sub-regulation 2 talks about the publication requirement. The advertisement must be published within 10 days from the completion of the post-issue activities, and it should be released on 1 English newspaper and 1 Hindi national daily newspaper. And these must be available on the websites of the stock exchanges where the IDRs are listed. So these are the key post-issuance regulations, like Regulation 209, which talks about the reporting of transaction, which about by the promoters and the pre-IPO details. So all the transactions in the security by promoter and promoter group between the filing of the offer document and issue closure must be reported. And deadline is within 24 hours to the stock exchange. Pre-IPO placement reporting, if any pre-IPO placement disclosed in the draft offer document, it must be reported within 24 hours of the transactions. Regulation 210 talks about the post-issuance report. The lead manager must submit a final post-issuance report to the SEBI, which includes the DD certificate and Schedule 16 Part A details like deadline of within 7 days of finalization of the basic allotment or refund of money in case of issue failure. And Regulation 211 says the fungibility of the IDRs, that ability to convert IDRs into underlying equity shares of the issue and must comply with the SEBI and the RBI guidelines as updated periodically.
See, primarily the purpose of the fungibility is, say, for example, you have purchased the IDRs here in India. and maybe you are actually shifted to the country in which suppose okay, they have issued the shares. So what you can do at that point of time is you can surrender your IDRs and you can get the shares there. And similarly, suppose you are having the shares there, whenever you come back to India, and you can again you can ask for the IDRs provided the headroom is available. This is what I told you in case of GDRs also, dual fungibility is allowed. That means you can surrender your shares and get the GDRs, or surrender your GDRs and get the shares. That is quite possible. And sometimes it also happens that a question comes that why an Indian has to buy the GDRs, See, what happens is that because of the time zones, the American stock markets or the London stock market might be opening when your Indian stock markets are closed. So sometimes it may so happen that the information what is available in the public domain, it also have some kind of an impact on the stock price. So some people what they do is they want to get the arbitrage, whatever is available, they want to avail that. And when you are doing it, though it might be sometimes a small amount, but when you are doing it, the quantum of shares are high, you may play in the market also. This is one way why people go for this GDR, ADRs fungibility also. Yes.
So now that we have completed the discussion on the public issue, let's move to the right issue of the IDRs. So there are key provisions which are given under chapter 8, like applicability, entities not eligible to make right issues, general condition, renunciation, record date, pricing, utilization of fund. So first of all, we are going to discuss about the regulation 212, which talks about the applicability for the right issues of IDR. And in addition to chapter 7, a listed issuer or offering the IDRs through the right issue must also comply with the condition which is specified in this chapter. However, the certain provision do not apply to right issues, including Regulation 191, Sub-Regulation 1 of Regulation 192, and Clause A of Sub-Regulation 2 of Regulation 183, Regulation 205, and Sub-Regulation 2 of 185 do not apply to the right issue. Regulation 213, it covers the entities which are not eligible to make right issues. Not all issuers are eligible to undertake the right issue. Regulation specifies the key disqualification, like in case if the issuer is in a violation of ongoing material obligation under the listing agreement, SEBI LODR regulation, or the depository agreement entered into the time of initial IDR offering. And if the promoter or director of the issuer is declared fugitive economic offender, the entity cannot take a right issue. Regulation 214 talks about the general conditions, and that might apply for the listing the new IDRs on all the stock exchanges where its existing IDRs are already listed and designated one of them as the primary exchange. So Regulation 21 says about the renunciation of an IDR holder. If the right issue allows IDR holder to renounce their right in favor of another person, subject to the applicable laws, which must be disclosed in the offer document. Regulation 216 covers the depositories. Like the depository, domestic depository plays a very crucial role in ensuring that the IDR holders receive the entitlement in the right offering and issuing the additional IDRs to the eligible holders and distributing the rights or arranging for the subscription of the unutilized rights. Regulation 217 is the record date. The issuer must announce a record date to determine the eligible shareholders. And if the issuer withdraws the right issue after the record date, it must notify SEBI and publish a notice in widely circulated newspaper. Regulation 218 discusses about the disclosure in the offer document and the addendum. Like first, the offer document must comply with the home country regulation of the issuer, ensuring that all the necessary disclosures are made as per the standards which are set in the issuer home jurisdiction. And additionally, for the Indian market, an addendum, also referred to as a wrap document, must be attached to the offer document. And this addendum should contain all the relevant information which is specified in Part C of Schedule 8, along with the clear instructions regarding the procedures and processes related to the right issue of the IDRs in India. And most importantly, the offer document and addendum must ensure that all the material information is true, correct, and adequate, enabling the investors to make informed investment decision. So moving on to the Regulation 220, which lays down the process for filing the draft of a document and the addendum for a right offering of IDRs. The issuer, through its lead manager, must submit the draft of a document in line with the home country regulation. Along with this, an addendum containing the additional disclosure as per Part C of Schedule 8 must be filed with SEBI, accompanied by the applicable fees. And SEBI may review the draft of a document and provide the observation for specify changes within 30 days. And this timeline should start from the latest of the following event, like receipt of the offer document, a response from the lead manager in case of clarification, feedback from any regulatory body, or in principle approval, which is given by the stock exchanges. And once the SEBI issues its observation letter, the issuer and the lead manager must submit the revised offer document incorporating the changes. And additionally, an undertaking from both the overseas custodian and the domestic depository, it must be provided to confirm that the compliance with the obligation under the respective agreement. So Regulation 223 is talking about the issue related to the advertisement. The issuer shall issue an advertisement for the right issue disclosing the following details, like the date of completion or dispatch of the abridged letter offer, and the centers other than the principal office of the issuer in India where the eligible IDR holder may obtain the duplicate copies of the application forms in case they have not received the application form, and a statement that if the eligible IDR holder have neither received the original application forms nor they are in a position to obtain the duplicate forms. And there is a format which is, enabling the eligible IDR holder to make this application on the plain paper, which is specifying there is a necessary particulars such as name, address, and client ID. So providing the basic information in the issuer's account, and a statement that the application can be directly sent to the eligible IDR holders through the registered post, and a statement that if the eligible IDR holders make an application on the plain paper, also an application form both the liable to be rejected at the option of the issuer. And sub-regulation 2 says the advertisement shall be made at least one in English newspaper and the Hindi National Delhi newspaper. So one regional language with wide circulation at the place where the principal office is situated. Sub-regulation 224, it talks about the periods of subscription and the issuance of allotment letter. A right issue shall be open for subscription in India for the period which is applicable under the laws of its home country, but not less than 10 days. And the issuing company shall ensure that it sends the allotment letter of rights to IDR holders at the same time sent to the shareholders for issuing the company. And Regulation 225 talks about the utilization of funds. If the issuer shall utilize the funds raised in the relation to the IDR pursuant to the right issue only upon the completion of the allotment process. So there is the taxation aspect of the IDR. So, the IDRs offer may of the, same rights and privileges are equity shares. So you could vote for against the company, get dividend, bonus, right issues, and when the company declares. So, however, the IDRs are not taxed in the same manner as equity shares. The taxation of IDRs can be less favorable for short-term gains due to the absence of indexation. And IDRs have similar with equity share, they are taxed differently when it comes to gains. And the taxation of IDRs in India depends on whether they are sold within a year or after a year, which falls under the purview of the short-term capital gain and the long-term capital gain. So if we see that IDRs are sold within 1 year of the purchasing it, the tax would rate on STCG for IDR is 10% without indexation. And the gain is calculated based on the difference between the sale price and the purchase price. And in case of the long-term capital gain, if IDRs are sold after 1 year of purchasing it, the tax rate would be 20% without indexation. And in this a process that adjusts the purchase price of the IDR for inflation over the period you hold. So there are some fun facts which we would like to share with you, that Standard Chartered PLC became the first global company to file for an issuance of IDR in India in 2010. And the IDR opened by the Bombay Stock Exchange and NSE on June 11, 2010. The Standard Chartered raised approx 24.9 billion rupees, that is 530 million US million dollar, in first issue of 240 million IDRs. The issuance of IDR provided Indian investors with an opportunity to gain exposure to the performance of international company without directly buying the shares in foreign market. Standard Chartered has raised that it is primary reason for listing in India. It is not to raise fund, but to increase its presence and to show the commitment to the Indian market. And every 10 IDRs represent one ordinary share of Standard Chartered, which is listed in London and Hong Kong too. So Standard Chartered also raised 14 crores by selling right issues entitled of IDR holders. The Standard Chartered PLC announces on March 2020 that it intended to terminate its IDR program. The company has now completed the termination of IDR program, and accordingly the IDRs have been delisted from BSE and NSE in India. So while IDRs have several advantages, they also come up with the inherent risk that the investors should consider. So one risk is currency risk, as fluctuation in exchange rates can impact the value of dividend payment. And additionally, the country-specific risk which is associated with the foreign company, such as economic downturns, pandemic, political instability, and furthermore, the IDRs represent the security that are not directly backed by the company's assets, and the depository receipt may be withdrawn at any time. And lastly, there may be the liquidity risk, as the process of selling shares and the distribution proceeds can take time, potentially leading to the lengthy waiting period for investors. So it is crucial to weigh these risks carefully before investing in the IDRs. And thank you. We are open for the questions.
Yeah. I can say only one question which is actually put up after we discuss whatever is there. And Indian investors invest in the area of the company X in USA, and for all purposes, it is actually considered as an equity shareholder. Please clarify, the name of A will appear in the equity shares holder in company X in USA, or custodian name will appear. Yeah, he said very clearly, because you see, what happens is underlying shares are actually given to the custodian. And the custodian, in fact, request the counterpart in the other country, that is India, to issue the DR. Naturally, the equity share which are actually kept with him, his name only will be appearing as a member, because he is actually the beneficiary who only receives and distributes. That's what Mr. Sudhakar said initially. Yeah, anybody
just 1 minute, Bala.
would like to raise the... Yeah.
I want to add further to that question. See, ADR,
Yeah.
it means an Indian company is issuing ADRs, right? And suppose if you are in India, you will never buy ADRs because you can directly buy that company's shares. Why you want to buy ADR? And I do, again, if at all you are, whether it is you are permitted to buy ADRs or not, also you have to see there will be a lot of rigmaroles. Suppose if you are abroad, at that point of time, maybe you will buy the ADRs. And the second question is, as I told initially, it is always the depository's name which is entered in the ROM, neither the custodian's name nor the shareholder's name. Custodian is only a mere custodian holding the shares on behalf of the depository. And that depository is having a list of the people who are holding that shares. That is, the depository is maintaining that. Whenever there is any kind of corporate benefits are there, like dividend or bonus issues are there, that deposit, that whatever the company will be giving it to the depository concerned, who is a member for all purposes, and that depository will be distributing it further to its DR holders. And as I mentioned again in the beginning itself, in case of GDRs as well as ADRs also, it is the depository which is having the voting right. That depository, it can also appoint a proxy on its behalf, or its representative also, because if it is a corporate, it will appoint its representative to go and attend the meeting. and vote thereat. Say for example, Indian company has issued GDRs. In that case, what will happen is that the depository will authorize its representative in India, just like a company is authorizing a representative for all purposes. That person will be counted for the purpose of quorum. He is not a proxy. But suppose if that person is not able to attend, he can appoint a proxy at that point of time. That proxy will do it. And similarly, earlier, as per the rules, it was permitted that, in fact, if I am not wrong, I think somewhere in 1990s, Reliance has issued the GDRs. So that time the condition was, whenever you are issuing GDRs, the Indian companies can have an understanding with the depository there that depository will vote along with the promoters voting. That means if the promoters are voting for, depository will also voted for, or the depository will be voted against, provided promoters are voting against. That kind of an understanding was also there. Whether it is permitted now or not, I'm not very sure about that, but it was there at one point of time.
We can check with the audience. If anybody has got any question, they can raise their hands so that we can permit them to speak. Anyone like to ask questions from the participant? Please raise their hands. Questions are welcome. Yeah, as of now, I don't see anybody raising the hand. What doubt comes in my mind, Sudhakar? The regulation is very good. Everything is laid down. More or less everything like our IPO processor, which are actually governed in the ICDR regulation. But in spite of all those things, this market somehow or other remained what we call very unexplored market, except that one incident what we discussed about the Standard Chartered Bank. Do you think it is because of the stringent eligibility conditions or criteria on hand, which you actually put in, which you have seen? What is the minimum market capitalization? What is the track record for the last 3 years? What are the distributable profits, etc.? Another thing, that is one. And second thing is again coming to the regulatory. In fact, you think there's a stringent regulatory compliances which are actually there. Actually, initially you said in a US, the stringent regulatory conditions are applicable. They're considered to the GDR issue there like that. So similarly, when it comes to their both the countries regulation, especially in the Indian countries regulation, people keep talking as though we have more regulation to govern. That is what they are talking about. Do you think these are all some of the things which attributes for this unexplored market?
No, I don't think regulatory stringency is the only reason. It may be one of the reasons, if at all. Say, for example, if you get your, suppose if Indian companies are issuing ADRs, ADRs is a very stringent this thing. The amount of disclosures what to be given. Of course, nowadays even the Indian, as per the Indian regulations, also you have to give a lot of disclosures. What I'm talking about in the past was what we have to give. If I have to give 10 disclosures here, you have to give about 20 to 30 disclosures there. That kind of a situation was there. But what happens is smaller countries always wants to issue in the larger countries so that they will get the credibility. Why the other way it will happen? Say, for example, are we going to issue, suppose tomorrow if Pakistan is also having, or any other small countries, they're having this kind of depository receipts, do you think any companies, Indian companies will go and issue it there? See, the purpose is that to tap the market, unless maybe in the coming years, since actually India is very economically becoming very strong and economy is doing very well, and it is going to be becoming that 5 trillion or $10 trillion economy. I mean, it is actually the next 2 3 years, it is expected to be the third in the world. When the economy is getting improved and your country is getting an image across the world, that point of time, definitely the foreign companies will look towards the Indian company and to get its shares listed here. So when there is a no direct listing mechanism is there, obviously they have to come through the IDR mechanism only.
Or do you think otherwise there are alternative investment methodologies available through the foreign direct investment, portfolio management, foreign institutional investors, etc. One hand, and the other hand is probably the IDR has not been aggressively promoted and awareness has not been much created. Do you think that could be one of the reasons?
I don't think so. I don't think so because awareness will be definitely there. Anybody, whenever they issue any kind of financial instruments, they want to say that what is ultimately at the end of the day, they see how I will get benefited because of that. So the foreign companies might not be finding it beneficial for them to come with an IDR issue here in India. They are not getting any extra mileage because of that. So unless until that extra mileage is there, even now Indian companies are also not going with GDRs or ADRs. Because if in fact, see that was there at one point of time when your country is small and all the completely opened economy was not there. Whereas now, absolutely that, in fact, the advantage, according to me, having the derivative instruments is more or less gone. That might be the primary reason. Okay.
Yeah, that is all I think from my side actually. I think now since we have answered all the questions and there is no one has risen the hand, we can definitely call it a day. We can close the session. One thing I must acknowledge receipt actually. All said and done, although this topic is very quite new, A9 is actually very well presented and she has brought out all the relevant points, etc. That is one thing, my appreciation to her. Number two, I was also expecting, since it's not the very familiar subject, that many people will be there. But I had seen actually almost about 140 people were there at one point in time. Even now I can see over 100 people are there. Definitely there is, younger generation would like to know, as you rightly said, oh, this we are not handled. Why should we bother? That sort of a thinking is there. There are a lot many people who are definitely interested in learning.
In
That shows
fact,
the very.
I must say that, say, for example, this commercial paper,
Yeah.
the commercial paper came, that instrument was introduced somewhere in the year 1988. I was working for a closely held company at that point of time. When this commercial paper has come, I read through the whole thing and I wrote an article. So somebody asked me a question. You are working for a closely held company. In your wildest dreams also, you cannot bring a commercial paper. Why you are taken the pains of spending time to understand the nuances of a commercial paper? That time, I always used to say one thing. Today I am working there, but how about tomorrow? Tomorrow I may get an opportunity to work for a listed company or maybe any other company where I have to handle the commercial paper. I cannot sit and understand the subject at that point of time. I should have a fair amount of an idea. It is the same thing here also when we organize this webinar. The purpose of this thing is the participants should have some kind of an idea about what is an IDR, what is a GDR, and what is an ADR. Now it is up to them to understand that why ideas, you are actually preempting the people to understand that why ideas are not successful here, why GDRs at one point of time Indian companies were craving to issue that. They're more or less, it is not there now. Whichever of the companies issued at one point of time, they might be continuing that, or some people might have even closed that also. So what is the reason for that? If somebody is interested, then you can always study that particular aspect. Having said this, that I must say to the participants, I requested earlier also, once again, I want to request, whenever you attend any webinar or any program, if you make some homework, that means the preparation for the subject, you will appreciate when the panelist or the presenter are making the presentation. Next week, we are going to have on the social stock exchange, and this is a new concept again. Social stock exchanges in India are there. So please have a look at it, what is the provisions and all those things, so that we can have a fruitful discussion next week. Thank you very much and God bless you all.
Somebody has put a question. I have a few questions while making the presentation. Can I share those questions? Yes, of course.
So basically, I put that like I have few questions which
you put. Yeah, please raise, please raise.
So
Yeah,
while making the presentation, there are a few questions which came into picture. So I would like to share. Like one of the question is should IDR holder receipts be treated as the trustee or investment purposes? So the treatment of IDR holder receipts depends on the nature of their holding. If an IDR holder is holding the receipts on behalf of another party, such as a beneficiary or under a fiduciary arrangement, so it may be treated as a trustee holding. However, if the IDR holder is holding the receipts for the personal financial gain, it would be considered an investment. So the classification depends on the legal and the framework under which the IDRs are held. And another question is, how should IDR receipts be characterized? An investor or holding, a trustee holding? And can IDR holders claim the tax benefit on the receipts held as a trustee? If the tax treatment of IDR held as a trustee holding depends on the tax regulation, which is applicable in the jurisdiction of the issuer. And generally, if IDR is held by the trustee, the taxation responsibility falls on the actual beneficiary of the IDR rather than the trustee. So the beneficiary may be able to claim those applicable tax benefit, but this subject to the specific tax laws, which is governing the trust and investment income in the relevant country. So IDR holders should be consult a tax professional for this kind of tax benefits. And there is a scenario, if an Indian company raises IDR to a foreign investor and IDRs are listed on foreign stock exchange, but the underlying shares are held in a demat account in India, then who is the beneficial owner of the shares? So in this case, if the beneficial owner of the
What you are
underlying
doing,
share,
Nayan, is it an observation or is it a question or what it is?
these are, sir, a few of the observations which I find during this research. So I thought if I can share that as well.
She is sharing the things what
Okay.
she has actually come across while doing the thing. Yeah. Yes, please. Yes, Nayan, go ahead.
No question of any holder is a trustee. You know. Only an investor. He's holding the derivative instruments. That's it.
Okay.
Yes, Nayan.
Yeah. So, sir, the answer was like in the case of IDRs, the beneficial owner of the underlying share is the foreign investor who hold the IDRs. So, IDR represent an ownership which is under the interest of the underlying share. So, these are held by the domestic custodian in India on behalf of the foreign
Nayan,
investor.
1 minute. See, this is this amount, this information which might be there on the internet.
Yeah.
Let you not give it on this webinar because unnecessarily it is confusing the thing and it may give a wrong meaning also to the people concerned. Okay, if anybody was interested, let them go it because you are touching the tax aspects and all those things, the trustee aspect and other things. To my extent, by that, let us not go into that. Let us leave it here only. Okay. So you have explained the concept of what is this thing and all. So as I told that, it is just like suppose if you are holding any ETF, okay. Suppose gold ETFs you are holding it, then what happened? That ETF you are holding the derivative instrument of that thing is gold. Not gold. So what are the ETFs you have to buy and you have to sell it in the market and you will get whatever the gains are there, the taxation will be there accordingly. Same is the case in case of ADRs and GDRs also. Ultimately, whenever and to the best of my knowledge, the person who is holding the DRs, he is an investor, he is not a trustee at all. So having said that, let us leave it here. And the people who are interested in understanding the concept more and all those things, whenever, as and when they are handling this particular instrument, they will do the necessary homework or research or whatever it is concerned. Or they may consult a lead manager who will explain to them everything.
One more question has come. In the practice, whether the IDRs are adequately liquid or they are more or less illiquid.
See, they're not very, at the same point of time, they're not very illiquid.
Not that much liquidity. That's what he means, I think so. When the moment
As far as IDRs are concerned, that's why even that's why Stanchart has closed it. As far as GDRs and ADRs are concerned, they are not very, the way the shares are traded in the market, the DRs may not be like that.
As you rightly said, initially, there are very few companies who have gone for ADR, GDR. Even the trading was very less volume in the market if you have actually seen in the market earlier. So to that extent, yeah, it is there actually. But IDR, unfortunately, it's only the Standard Chartered Bank is the only one which is the known thing. Other thing we have not seen. So I don't think we'll be able to straight away say this on this. Yeah, that is why probably, as you rightly say, They ran for about 10 years. After 10 years, they got delisted, they got out of it. Yeah. I think that is all I think.
Okay.
It's a very knowledge adding session for me also. I never handled this actually because it's a new topic altogether to me, really speaking. There are a lot of things which we could understand. We could actually know what is the ADR, similarity and other things and all. It is definitely a knowledge adding session. So I'm definitely sure it will be very helpful to the people, participants who are here to know the things as rightly. There is no end to learning actually. It's really a very good session for me. I hope it is the same to everybody. There are a lot of appreciation also has come, Sudhagar, saying that please keep it a very good session and very well conducted webinar. All those things which has come actually. Super webinar, somebody has actually put. So it's a very good idea, Sudhagar, for you. I am personally thankful to you for getting the things and exploring the things like that. Again, thanks, Nine, for your beautiful presentation, putting the things together in the very capsule form. Thanks a lot. I think with this, we call it a day and we will meet yet another session the next week. Thank you. Thanks a lot.
Thank
Have
you.
a good
Thank
day.
you very much. God
Thank you,
bless.
everyone.